with FP Deputy Editor Cameron Abadi.
Hello, thank you all for being here. It is an exciting panel to be discussing here at the FP Geoeconomics event. So in addition to being an editor at Foreign Policy Magazine, I co-host a podcast that is produced by Foreign Policy. That's called Ones and Twos. It covers economic issues generally. And for people who have not listened to it, we start every episode with a data point relevant to the topic we're discussing. I thought I would try to do the same thing for the panel here today. The data point I have is 428.9. That is the level that the Global Economic Policy Uncertainty Index hit last year in 2025, that was. Now, for people who don't follow that index very closely, I include myself in that. That's a very high number. It's 13 times higher than the standard deviation, so really kind of off the charts. And that level of policy uncertainty was tied to President Trump's Liberation Day trade policy announcements. Now, that was a clear shock to the global trading system. And but as I mentioned, that was a year ago, and a lot has happened in the year since. We live in a world that is affected by all sorts of shocks, is affected by even more uncertainty than it was a year ago. One only thinks of the ongoing war in the Middle East and the other wars that have occurred in the interim. Trade continues to be uncertain, migration, alliances, climate change and the effects of it, et cetera. So clearly we are living in a world prone to shocks, and with our distinguished panel here, we were hoping to discuss the effects of that and how to respond to them. But first, I was hoping to begin by talking about some of the causes of these shocks, or at least, the shocks themselves that we're talking about. Dr. Ghosh, I wonder whether, I mentioned various causes of shocks, but are we only dealing with the present shocks themselves, or are the shocks, when we talk about shocks, are we also dealing in some sense with shocks that from the past? I mean, how should we be thinking about shocks per se when we're talking about them?
Okay, if you're thinking of the drivers of shocks, there are systemic drivers, and then there are the things that happen immediately, which is the specific cause at that moment. But the reason they reverberate so much is because of the systemic factors. It's because of not just the growing interdependence, but especially for the developing world, which will be my perspective, especially for the developing world, we have multiple impacts, massively intensified and accentuated impacts of what may seem like relatively small shocks in richer countries. So, okay, Ukraine war, inflation rises, monetary policy tightens in the US. Not only do interest rates rise massively for the rest of the world, but our sovereign bond spreads go through the roof. So we have the multiple whammy of that, which doesn't get noticed as a global shock, but it is a really bad shock for countries in all of these other countries. Anything that has happened, the war, okay? It's not just the oil importing countries that are hit. It's not just the countries who's depended on the Strait of Hormuz for their imports. It's all the other countries, whether or not they are importing oil, are facing this massive difficulty. And it's a multiplied shock. I mean, in the US, it feels like just more money at the pump or something. But we are talking about people losing livelihoods already in South Asia. We're talking about people going hungry already in large parts of the world. So these are shocks that are magnified by the inequality, which is systemic.
No, that's a useful reminder that the effects, in some sense, also compound. We have President Trump already saying that the effects are going to be gone very quickly, and that the war will be over, and that the price of oil is going to drop, and no one is going to notice. But I think for reasons that you're describing, it's obviously much more complicated than that.
Can I just, one addition to that, when the prices fell after in 2022, the oil prices, they did not fall for 90% of developing countries. They stayed the same or went up because currencies had depreciated in between.
So to turn to you, Laura, you'd written recently what I think was a fascinating paper. I'm not sure if it's officially published. I saw a draft of it.
Yeah.
Okay, well, I would encourage everyone to read it. I believe it's with Project Syndicate. And it describes, when we're very familiar with talking about these shocks from the perspective of importing countries. But you took, I think, an interesting perspective, which is to look at it from the perspective of energy exporting countries. And first of all, to address the fact that they're also affected by, they're also vulnerable to these shocks, but then also thinking specifically about what exporting countries can do to make themselves more resilient. Could you discuss a bit about what you wrote there and what your recommendations are?
Sure. I think the first instinct that analysts had when they started to project what this Hormuz crisis would create for countries was to really distinguish between net exporters and net importers. And that was the main lens by which we started to look at the world and sort of split countries and do maps. And of course, this is a really relevant dimension. As Jayati was talking about, we actually have importers are the most vulnerable in terms of bond spreads and exchange rate devaluations and are struggling to deal with the short-term effects of this crisis. But then we started to see that there are other dimensions that actually explain vulnerability and the degree of vulnerability. One of them, which I think is very key for exporting countries, is of course their energy systems and how diversified energy sources have been. We saw all these examples that are popping up in Europe with Spain and even China that had much more resilience than some had expected at the beginning because of the 50% renewable energy matrix and the reserves in oil, the oil reserves that it had accumulated. Then Brazil, where I come from, where the biofuels infrastructure was very relevant and mitigated a lot of the effects and the pass-through from the shock to consumer prices. And so there's a level of exposure that is explained by previous investments. And so here, and this is not the only, of course, there are other dimensions that matter. It's the country's fiscal space, how much debt they had, and their capacity to create fiscal buffers for the shock. But the fact that for exporting countries, there is an increase in oil revenue and profits and windfall profits, both at the state-owned enterprise level, but also even fiscal revenue that is attached to commodities in these, and fossil fuels in particular in these countries, actually give an impression that, wait, maybe they're benefiting from it, and because there's all this money. But this money is not distributed with the population who is suffering the effects on consumer prices. And so are there mechanisms, and which mechanisms can we focus on that would help rechannel some of those windfalls towards an agenda in the short term to better absorb the shock and protect consumers in those contexts, and for longer term, medium to long term investment in resilience by diversifying these countries' economies, investing in the energy transition, and making them less exposed in the future. And I think there are different proposals there that we could discuss.
Interesting, yeah. I mean, in the specific case right now of Brazil, are there efforts to protect consumers from these elevated prices? Is that happening?
There are a set of different fiscal measures to prevent some of these price shocks to be transmitted towards not only the fuel prices but also food, right? Which is going to be the next stage of this crisis, the fertilizers and how they will translate into higher food prices. But there are also other elements that we can look at, like the Brazilian state-owned enterprise Petrobras, which is the oil company that sits on a lot of oil reserves, is of course benefiting in the short term from the higher prices. But Petrobras was already investing in renewables and biofuels as a strategy for its own diversification, because they're worried that the rest of the world will be transitioning and they will be left with just stranded assets. And there is a risk that this crisis actually, people are looking at oil exporters as if they were the less exposed, but in fact, the fact that they rely on this and the rest of the world is actually perceiving the benefits of the transition to other energy sources, like in Europe, in Asia, everyone will try to accelerate their energy transition. And then if you only depend on oil, you're gonna be facing more risk in the longer term. And so these countries are trying to invest in not only economic diversification, but also biofuels, for example, and other things that they have capacity to do.
It's also an interesting contrast, again, with the United States, where you have the Trump administration talking about how this could be good for the U.S. economy, but precisely discouraging any shift to or transition to renewables. And that could be one of the ironic effects of this war that the United States obviously has chosen to fight, is this actually accelerated shift, including by fossil fuel companies, it sounds like.
And energy security is not a climate, it's not a green luxury. The energy transition is not perceived anymore. It cannot be perceived in this context as like a woke agenda, right? It's national security, it's sovereignty, it's energy security. It's clearly in the middle of everything that countries care about right now.
You say
right?
it can't, and yet one sees that to some extent maybe it still can. But I would love to turn the perspective a bit to the perspective of importing countries that we were just discussing, and I know that your research has focused a bit on what importing countries can do to manage these shocks. Could you discuss that a bit?
Sure. I mean, but there are many, but I want to highlight two in particular. We have to focus on the essentials, the price of essentials, and it's food and fuel, finally. And those are the sectors that have had the most shocks in the last 3-4 years, right? So there are possibilities of using buffer stocks. China has them, Brazil has them, India has them in food. But you can think of a regional level buffer stock, let's say for Africa. In fact, we had suggested one for the African Union. Isabella Weber and I had done a study where the African Union combines to actually do continuous procurement and distribution across surplus and deficit countries. And if such a mechanism had been in place today, they would not be reliant on imported food, at least to the extent to which they are, because there's sufficient regional production to be actually that way autonomous from that kind of shock. Fuel is a tougher one. It's a universal intermediate. It causes all prices to go up, and you can't simply say we'll just build up the buffer stock, like the U.S. strategic reserve. But the other big element of resilience, which I think is increasingly necessary, is financial. So I just go back to that. The reason why developing countries are so much worse hit by every particular shock is because we're at the bottom of the currency hierarchies. So we always get worse, we get worse borrowing conditions, we get higher interest rates, we get big spreads on our sovereign debt, etc. And so any country that is even mildly vulnerable to debt stress becomes severely debt stressed with these shocks. So essentially, we have to stop borrowing unless we need the foreign exchange. We shouldn't be borrowing just to fill gaps in public finance, which is what the World Bank and IMF and Davos have been encouraging us to do. We have to stop doing that. We have to bring in capital management techniques, nice way of saying capital controls, to actually prevent that kind of volatile movement which causes the currency to depreciate and makes all the other shocks worse. So I would say financial deregulation, financial deglobalization is actually essential to avoid shocks in the future.
I would love to return to this question of macro strategies and what exactly could be done to make countries more resilient. But you mentioned multilateral institutions in this context. And I wonder if you have thoughts on the role that multilateral institutions could or should be playing here in responding to shocks or in terms of dampening the effects of them? Are they playing a productive role already, or could they be playing a different one that comes to mind for you?
I'll start from Jayati's point. There is a difference in this scenario relative to other crises, which may be structural, we don't know, which is the role that the dollar has played in the international monetary system in the past. And I'm not saying there is going to be a replacement to the dollar in the even medium to long term, but the fact that the dollar is not playing, that the U.S. is not attracting all the capital as it did in moments of crisis, right? Like there was this huge flight to safety. U.S. treasuries were the safest thing you could hold. And now it's not exactly like that. There's been instances in those shocks that we just discussed since the last year that where Liberation Day and other moments of uncertainty in the global financial system where you didn't see a huge inflow of capital to the U.S., which meant that interest rates in the U.S. that tend to fall in moments of global crisis didn't fall because you had inflationary pressure happening. And that's a problem because for the rest of the world, they always relied on that counter-cyclical monetary policy in moments of crisis where the Fed would lower rates, and this allowed every country in the world to also lower rates because that's how an integrated financial system works with a lack of autonomy for monetary policy in the rest of the world. And that meant they could at least increase their spending or adopt counter-cyclical fiscal policies domestically because the cost of capital was lower, because the debt service costs were lower. Now you don't see that anymore. There is no automatic mechanism, there's no endogenous mechanism in this system that actually brings counter-cyclical possibility or policy space in moments of crisis and fiscal space in moments of crisis for the South. And so the role of multilaterals, to answer your question, one of them is to actually act like that counter-cyclical safety net and provide the fiscal space that countries don't have in moments of shock like this. And we feel, I'm not sure if it's because there's still uncertainty as to how long the Hormuz crisis will last, or if it's because this crisis was initiated by the US and not by a virus, like with the pandemic, right? But I'm not sure we're seeing an ambitious response in terms of fiscal relief for countries in the rest of the world. We saw some, and I think it still remains to be seen if the international financial institutions will provide the type of liquidity that they have provided in the past, and we hope they will.
Can I provide a ruder answer to that question?
I'm always happy for a ruder answer.
So, the IMF was set up to be a global financial safety net, okay? If not now, then when? It has done zilch on that. And there are some really simple things that could be done under the Articles of Agreement, okay? Number one, you could simply release more SDRs, increase an SDR allocation, because if you think of SDRs as part of global reserves, they should be increasing along with global GDP. So in fact, I was part of a board that reported to the Secretary General on effective multilateralism, where we suggested this. We said the allocation of the issuance of SDR should be increasing along with global GDP, which would mean about 250 billion every year would go into everybody's accounts, SDR accounts. Second, there should be at least half of those should be kept specifically to act as a financial safety net. And things that would trigger it would be a massive terms of trade shock, a massive exchange rate shock, a massive interest rate shock, some kind of, or maybe a climate shock. You can have identifiable things that say, if you get this shock and the estimated impact is so many $1 billion, you get so many billion SDRs.
I mean, so we're all here in Washington. This is the week where the IMF, the World Bank are meeting. So why is this not happening? You say there's very obvious, simple responses. So what is the holdup as far as we can
tell? The US, okay? You need to have 85% of the votes to carry this. The US has 16% of the votes.
Okay, yeah.
I want to mention something about the bank, because we talked about the IMF and what it could be doing. And the bank has a big role to play in providing the type of finance that countries need for that resilience agenda and the sort of energy transition as part of a broader agenda of resilience, right? There are the climate shocks that countries are vulnerable to. There are supply chain type of shortages and shocks that we've been living through. And an economic diversification agenda, an agenda that allows countries to not rely solely on extractive industries, on commodities, and instead diversify their economies in ways that would build resilience. Because a resilience agenda is also an agenda of not depending on one thing. It's not always that the oil prices will go up. They sometimes go down, and volatility is increasing. And so if you rely on that, you're going to be very vulnerable. And so that economic diversification agenda would be great to see the bank. We saw this recent report by bank research economists on industrial policy that sort of reviewed the previous thinking since the 90s and says, look, maybe that East Asian miracle analysis that the bank has produced in the past that sort of didn't put a role or emphasize industrial policy as part of that growth experience is not something that is valid today, or they did some kind of mea culpa of this, the way they looked at this, in a moment where rich countries are all looking at industrial policy and adopting it in different ways. And I think there is a need for the World Bank to have an approach that allows countries in the South and that helps in financing, for instance, national development banks in the South, leveraging the capital of national development banks, de-risk national development banks for these strategies to be adopted in the global South. So they need the kind of long-term, low-cost funding that the bank can provide. And that's the only case in which I think foreign borrowing would make sense, if it's for long-term structural change. Yeah. Right.
I mean, I suppose, I did want to then return to the proposal you had falling under the heading of deglobalization, and I wonder how that aligns with this discussion of a renewed relationship to multilateral institutions. I mean, if there's if you're recommending countries in some sense become more self-sufficient. And maybe more cut off from these international capital flows. I mean, what are the risks of that approach, and how can one address those? I mean, are there risks of deglobalization that we could be overlooking in that kind of approach?
Can I begin by identifying the risks of globalization first?
Please.
So, what have most developing countries gained from capital market integration? Think of the success stories. Very few, right? Okay, China, it was never really fully deregulated. They heavily regulated the capital inflow when they got lots of it, with many, many different kinds of constraints. And then, of course, they became capital exporters. But the countries that are seen in Asia as successes, let's say Malaysia, Thailand, India, these are all seen as big success stories of globalization. We got a lot of foreign capital inflow. If you look at the seigniorage costs, that is the difference between the interest rates that we pay foreigners who invest in our countries and that our investors get when we invest abroad, including our central banks that are holding US Treasury bills. The numbers over a period of 20 years range from about 3% of GDP for India to 5.5% of GDP to Thailand. That is every year you are losing 5.5% of your GDP on interest differentials for borrowing that you didn't need to do in foreign exchange. And that is more for Thailand than all forms of foreign capital inflow put together. So how has that open capital account served the success stories? Of course, we don't have to talk about the debt-stressed countries. We know what happens. It's bad news. And then you end up with lost decades where you are much worse off than you were at the beginning. Your development cycle gets broken. You're not able to fulfill the long-term projects that Laura mentioned. So, if financial globalization could have delivered, it would have delivered, at least to some countries. Now you look at the so-called success story countries, they have lost from that. They've succeeded despite the financial integration. So why are we so obsessed with that? What is the risk of financial deglobalization? Well, the big global banks and private equity funds will not like it. It's a big risk. I live with it.
Yeah, that is a risk. Exactly. I guess one could leave that open. What could they do in response? But I was going to say one thing. When we do when I do one of the podcast events, we do take questions from the audience. And actually, in this particular case, we had some questions that were asked ahead of time. So I guess I'll pose one question that came from the audience, and it came from Abadi Cheko from the Gates Foundation in Ethiopia. And I wonder if we have a couple of minutes left, if anyone has thoughts on how can policymakers balance the use of geoeconomic tools such as sanctions and industrial policy with the need to maintain open, inclusive global economic systems, particularly for developing countries. So is there a way to balance this new era of industrial policy? We're talking also about sanctions as an increasing use in geoeconomics. Is there a way of balancing that with, maintaining global economic systems? But it sounds like there's a consensus that maintaining these global economic systems aren't necessarily a priority.
Let's talk about a new global economic system, right? One that actually works, which I do believe is not just about national policies. I do believe in cooperation, and I think we have, even if we are not seeing cooperation work in the way that we would like to see, there's still a role if you have industrial policies at the national level in countries. There's still a big role, and in fact, the success of these industrial policies is much more likely if they are coordinated to some degree. And so there's a lot of room in the current context of fragmentation for countries to come together. For instance, they have different pieces of supply chains. They have complementarities where they produce and they hold different technological capabilities, and they come together. We saw an example in the first panel today with the Undersecretary of the US State Department talking about this Pax Silica coalition that the US is leading on semiconductors, right? So even the US is doing coordinated industrial policy with Japan and the other developed countries that are in the coalition. And so I see an urgent need for global South economies and developing countries in such a context to actually coordinate among themselves at regional level, at sectoral level, those that hold critical minerals. How can they come together to set prices in ways that favor their objectives, their development objectives, how they can come together to look at their industrial strategies and their supply chains and the clusters. There are some that are doing that. There is a green industrialization African initiative, an African green industrialization initiative that is a group of countries that are looking at certain clean tech supply chains and what they can do together to advance those. And there is where cooperation plays a role. It's the same with taxation. Jayati can talk more about that, but taxation is also a cooperation agenda that we would like to see advanced.
Would you like to add to that?
Well, only about sanctions.
Please.
I mean, sanctions in today's world, they are instruments of the powerful against any policy group, whatever, etc. they don't like. They have not been successful in achieving any of their aims. They are very destructive for humanity, for people. They have killed more people in Iraq than the war did. And Cuba, I mean, I don't even want to go there, but yeah, sanctions are a disastrous tool, but they're also a little bit counterproductive for the sanctioning country. Because I think there's no doubt that clearly the decades of sanctions in Iran have allowed them to develop really amazing engineering capabilities, which we're discovering now for the wrong reasons.
Well, again, one of the ironies of economic policy, but it sounds like we've arrived at a consensus that maybe there's some way of having deglobalization with some coordination as a way of managing these issues in the future. But for now, we should conclude this conversation. Again, thank you all for listening, and enjoy the rest of the day.
And now,